Hello, everyone. We got a few more minutes here, and then we'll jump into chapter 16. Again, as always, feel free to say hi in the chat. Again, as questions come up, you can always ask a question, and I'll do my best to answer it. And obviously, we're going to try to keep it as interactive as we can. Hey, Harry, how are you? Hi, Paul. Hey, Malachi. Hey, Samantha. Hey, Nate. Hey, Junwan. I hope I said that right. Oh, you go by Will. That's right, you go by Will. All right, well, we're a minute into it here, so I'm going to go ahead and get started. I know right now there's only, looks like there's only 8 people online. Thanks, Will. I did send out an email earlier this morning about study groups. I know we're about a week into it. I didn't want to be premature in sort of addressing any problems that the study groups might be having, namely, non-responsive group members. But this morning, hopefully, my email will prompt, hey Ryan, a little more activity. And so, especially those of you that are on this chat, feel free to reach out to your group members. If somebody is being non-responsive, just let me know. And this isn't meant to be a situation where they sign up for a group and then don't do anything. That's not the intention. And so hopefully that kind of prompts everyone to get involved and start creating something that's going to work and help everybody. Because I'm convinced thoroughly that studying together and working together is going to improve everybody's performance. And so I think it's worth the investment. All that to say, today we're talking about dilutive securities and earnings per share, and for most students, everything we've done up to this point is probably at least somewhat familiar. Hi Aiden. Hey Raphael. This chapter tends to be one where it's pretty new for most folks, and so I'll tend to move a little slower. There may be more questions. I totally get that, but this may be one that you need to review several times as well. So just be aware of that, and of course I'm completely aware of that. Hey Henry. All right, so let's kind of jump into this here. So basically, the idea here, there's two pieces to this. The number one, I'd say the one that most students probably think the most of is the idea of equity-based incentives for employees. And so whether it's stock options or restricted stock, this is a very common form now of compensation within companies. And so, of course, we need to learn how to account for them. And so, obviously, sometimes this will involve issuing other securities like an option rather than issuing the shares themselves. And sometimes it actually is issuing shares. And so there's just a lot of these things we're going to talk about. I also recognize that we could spend 3 weeks on this type of topic depending on how deep we wanted to go. But we're going to kind of just, this is your first introduction to it. So we're going to cover a lot of different things, but probably not to the depth that we otherwise could if we wanted to. The other part of this is companies making this choice to finance through debt or equity. So that's kind of a major component. Kind of think about Chapter 14 and Chapter 13, we were talking about debt. In Chapter 15, we talked about equity. And so in this chapter, we're kind of bringing those two worlds together and saying, okay, companies have this choice to make. Do we issue debt or do we issue equity? And there are benefits and drawbacks to each. The big difference is that debt introduces financial risk. Now, risk is not good and it's not bad. It's just different. So risk kind of multiplies the returns or it multiplies the losses. And so financial risk is just what it says. It's just riskier, but it's not better or worse. But the more debt that a company takes on, the more financial risk that they have. The benefit to that, of course, that it increases returns on to equity for investors. In other words, if the company performs well, so I think a kind of a classic example is when somebody buys a house. So let's say that I could buy a house and put no money down, or let's just make it easy, $100,000 house, and I put 10% down. So I invest $10,000. Well, if that house appreciates 10%, then the house is going to be worth $110,000. And so from my $10,000 investment, basically I had a 90% leverage. I had 90% debt on this thing, and so it increases $10,000. Well, the interest that I might pay on $100,000 is going to be fairly negligible in a year. But if it goes up to 10%, I mean, I'm going to get an 80 or 90% return on my investment. So that's a pretty good deal. Whereas, let's say that I just paid cash. If I just paid cash, there's no interest, there's no debt, but I had to invest $100,000. If that same house goes up 10% in value, my return on investment is only 10%. And so it's sort of, the upside is pretty dramatic. Now, the downside, of course, is that if I invest $10,000 and finance the rest, and let's say that it goes down 10%, well, now I've essentially lost my entire investment, whereas I would only have lost 10% of my investment if I had invested the full $100,000. So it's again, as a return, it's a percent return, not dollar return. It's a percent return. Okay. There are securities that we're going to talk about that have elements of both. So they have elements of debt and elements of equity. We're going to talk about those in this chapter. All right, convertible debt. That's the number one. This is the number one, probably the most common type of security that has elements of debt and elements of equity. And so convertible debt, it provides the debt holder, like usually a bond holder, it gives them the option to convert their debt to equity at a future date. And so, again, the initial issuance is in the form of debt, but that debt holder has the option to turn that debt into equity. And so it does have elements of both. Under U.S. GAAP, there is no direct impact on income attributable to the conversion. So in other words, when that debt holder converts, or if that debt holder converts their debt to equity, under current U.S. GAAP rules, there's not going to be a gain, there's not going to be a loss. You're just going to take the debt off the books and bring the equity onto the books. So there's no gains or losses. Now, this is important. The conversion option may reduce the yield on the debt. So this is an indirect effect. In other words, there is value to having the conversion option. And so a lot of times the yield on that debt, in other words, the market's required rate of return, is going to be lower because of that conversion option. And so the company will have a lower interest expense as long as that debt is outstanding. So there is an indirect benefit to having the conversion option. There's just no direct income effect from the conversion itself. So there are three aspects of the conversion that we need to consider. First of all, we do have the issuance of the convertible debt. Under current U.S. GAAP rules, the entire issuance is allocated to the debt instrument. And so at issuance, the company acts as if it's just like any other debt instrument. So a bond payable, note payable, whatever it might be, without any attention paid to the fact that there's a conversion option. At conversion, U.S. GAAP requires what's called the book value method. And again, just to explain that means you take the debt off the books and you bring the equity on the books, and there's no gain or loss. And so you're just using the book value method. And then finally, if you have convertible debt that's outstanding and you retire, so if the company were to go out into the market and repurchase that debt or otherwise retire that debt, then you could have a gain or a loss, just like you did in Chapter 14. So that's really no different than anything we had talked about in Chapter 14. Okay, so let's talk about an example. So a firm issues $500,000 in 10-year annual bonds. The coupon rate is 5%. The bonds are issued at 102, which of course, hopefully by now we understand is a premium. The bond includes a conversion option where each $1,000 bond can be converted to 20 shares of stock. The bonds are issued on January 1st, 2020, and then 300 of the bonds are converted on December 31st, 2022, and then the remaining bonds are retired at 102 on December 31st, 2023. The firm uses straight line method to amortize the bond premium. So for this chapter, when we're amortizing bonds and things like that, we're just going to be using the straight line method just to kind of keep it simple. I don't want you to have to create, an effective interest amortization table or anything like that. Okay, so let's kind of walk through these journal entries. So the first journal entry hopefully looks very familiar. Since they're issued at 102, that means that the proceeds from the issuance were 102% of the par value, which would be $510,000. So the cash that the company is going to receive at issuance is $510,000. Of course, we allocate the par value to the bonds payable, and then the amount above par to the premium on bonds payable account. Again, I'm hoping from Chapter 14, this is a journal entry that you could do nearly in your sleep at this point in time. Okay, so now the second piece. So whenever we talk about these conversions, because some but not all of the bonds can be converted, you do have to think about each individual bond. And I think if you can keep each individual bond in mind, you have a very good chance to actually do the conversion correctly. And so if you kind of think about the premium per bond, it was issued at 102, which is basically means that the premium is 2% of the par value. And so since the par value for each bond is $1,000, that means that the premium per bond is $20. So there's a $20 per bond premium as part of this issuance. So then the annual amortization using the straight line method would be $2 per year, again, because these are 10-year bonds. So you take the $20 balance per bond, allocate it over the 10 years for $2 per year in annual amortization. So on December 31st, 2022, there's a conversion of those 300 bonds. So we're going to kind of keep this information in mind as we account for this conversion. So first of all, you have to take the converted bonds and any associated premium off of the books. And so in this case, the bonds payable entry, you have $1,000 per bond. That's the par value. And we apply that par value to the 300 bonds that are being converted, which means that the entry for the bonds payable account is going to be $300,000. And then for the remaining premium balance, so this is where you kind of have to think about what's going on. And so on December 31st, 2021, actually I could go all the way back to 2020. The company would have amortized $2 of the premium for each bond. They would have done the same thing in 2021, and they would have done the same thing in 2022. And so in other words, there would have been 3 years of amortization that would have occurred prior to this conversion. And so since there's at conversion, we're taking the premium off the books, the only part of the premium that we're concerned about is any remaining balance. And so there's $2 in the first year, there's $2 in the second year, there's $2 in the third year. And so this whole idea is that out of the total of 10 years, they would have amortized 3. And so the remaining balance, again, the initial balance was $20 per bond, and only 7/10 of that remains. The other way to think about it would be that, well, we amortized $2 over each year for 3 years, which means there would have been a total of $6 of amortization, and given an original balance of $20 per bond, the remaining balance would be $14 per bond. So at this point in time, at the time of the conversion, each bond has a $14 balance for its premium on bonds payable account. Does everyone kind of understand that? If you just give me like a yes or a, I don't know if we can do symbols in here, you can give me a thumbs up, whatever. Is everyone kind of following where that $14 per bond balance, where that comes from? Because that's usually, in this problem, the hardest part to understand. Good, Harry's got it. Aiden's got it. Thomas, good. And again, if you need me to re-explain it, just let me know. Ryan's there. It's good. Okay, good. Again, if you have any questions, just let me know. Okay, so you have that per bond balance. And so then, of course, we need to apply that So Raphael says, so it's 14 after year 3. Yes, exactly. And Nirmal Kumar wants me to re-explain. So let me kind of go back up. So just one more time. So the idea here is there is this ongoing amortization process. So we issued the bonds on January 1st, 2020. And so what we have to do is imagine in our minds, okay, what's been going on with this bond over the last 3 years? Because now we're at the end of 2022, which means we've had 2020, which is 1 year, 2021, which is 2 years, and 2022, which is 3 years. And so we would have recorded the interest payments every year for 3 years. As part of that process, we would have been amortizing the bond premium. Again, $2 per year. So if you kind of think about that, that's $2 in the first year, $2 in the second year, $2 in the third year, for a total of $6. And so the amortization of that premium would have been a total of $6. With an original balance of 20, you subtract the 6, which means there's a remaining balance of 14. The other way to think about it, which is the way I most commonly think about it, is to say, well, how many years remain in this bond's life? Well, we're at the end of year 3, which means there are 7 years left. And so since there are 7 years left on this 10-year bond, it means that 7/10 of the premium balance must continue to exist at the time of the conversion, which again, 7/10 of $20 per bond is 14. So again, that's kind of the two ways to think about it. And then we take that $14 per bond balance and we apply it to the 300 bonds that are being converted. And so the entry to the premium on bonds payable account is going to be $4,200. So again, we're taking the bonds and the associated premium off the books. So we need that premium balance off the books. No problem. Okay, and we also then have to, great. We also have to record the issuance of the common stock. So we're taking the bonds off the books, and now we're recording the fact that we're issuing stock. So we're going to issue, again, the conversion option means that every bond can be converted into 20 shares of common stock. And so that means there are 300 total bonds being converted. And so each bond can be converted into 20 shares. So 300 times 20 means that there are going to be 6,000 shares that are going to be issued as part of this conversion. So the common stock journal entry, you take those 6,000 shares, and of course we know for the common stock entry, we credit that account for the par value, and the par value of the common stock is $1 per share. So there's going to be a $6,000 entry to our common stock account. And then our APIC common stock account is just a plug that makes this all work. And so the APIC common stock journal entry, the idea here, again, this is the book value approach. It just serves as a plug. And so since it serves as a plug, there's no gain and there's no loss whenever these bonds are converted. All right, so then the journal entries. The first part of that is what we've already calculated, and that's taking the bonds payable off the books and the associated premium on bonds payable off the books. Again, that's from this calculation that we had just done, kind of in the middle of the screen there. And of course, then we're bringing the common stock. We're issuing the common stock, so we credit the common stock account for the par value, and then APIC common stock for any amount above par. So any questions on the journal entry for the conversion? Okay. So now we're going to retire the remaining 200 bonds. And so we kind of have to continue to go forward, right? So now we got to think, okay, another year has passed. And so there would have been another year of amortization, another year of interest payments, all those things would have happened. And so now we have to imagine where we are at this point in time when we retire those bonds. A couple of things, again, like if we kind of go all the way back, I don't want to go too crazy here, but there's a lot of information in this example. And so it says that on December 31st, 2023, so on that date, the remaining bonds are retired at 102. And so it's really important that we understand that there was a price that was paid, and that price was 102% of the par value. And so we're going to take that information and think about how to do this retirement. So first of all, again, we have to take the convertible bonds and any associated premium off the books. So again, with the bonds payable entry, the par value per bond is $1,000. We apply it to the remaining 200 bonds, which means the entry to the bonds payable account is going to be $200,000. Again, I'm hoping that part of it's not too difficult. With the premium on bonds payable, again, there's been one more year of amortization. So now instead of the 7/10 remaining, there's only 6/10 remaining. And so the balance in the premium is going to be 6/10 of the original $20 balance. Again, the other way to think about it is, well, we amortized $2 each year for 2020, 2021, 2022, and now 2023. So there would have been 4 years of amortization at $2 per year, means that total amortization of the premium would have been $8. And so given the original $20 balance, we subtract the $8 of amortization, which means the remaining balance as of the time of this retirement would have been $12 per bond. Again, I tend to think of it in terms of just the remaining balance, just the percent. That's just kind of how I think about it. But you can also just think mechanically through the amortization process, and you should be able to get to, you will get to the same answer no matter which sort of approach that you use. Again, I'm hoping this time through it's a little easier to understand where that $12 per bond balance came from. So for the entry, of course, we apply that $12 per bond balance to the 200 bonds that are being retired. We have to record the cash payment. And of course, for the cash entry, they are paying 102%. So again, the 200 bonds times the par value times the 102%, which is the cash payment that they made. That's the price that they paid. So they're going to pay $204,000. Now, because we are retiring these bonds prior to maturity, there could be a gain or a loss. And that gain or loss is just a plug in the journal entry. It's the difference between the amount of cash that we paid and the book value of the bonds that we're taking off of our books. And so again, we have the bonds payable, $200,000, the premium on bonds payable, $2,400. Again, that comes from the prior calculations that we just did. The cash payment is $204,000, and hopefully you see that we paid more than the book value of the bonds. And since we paid more than the book value, there is going to be a loss on bond retirement of $1,600. And we kind of just sit there for a second in case anybody has any questions. Okay. Looks like we're all right. All right, stock warrants. So Nate asks, can you slow down a little? Yes, Nate, I can slow down a little. I know it's sort of when I'm staring at a blank screen, it's kind of hard to see how fast y'all are writing and who's all keeping up and who's all not keeping up. Let me go back. I'm guessing you're trying to catch up on the journal entry. So Harry asked a good question. So since they were bought, or I would say issued, not bought, but I understand what you mean. Since they were issued and retired at the same price, why is there a loss? And the reason why is because of the amortization process. So if you kind of think about, I don't know, I wish I could draw this. Maybe I can't. Let's see. Give me a second. Give me 1 second. Hopefully this will show you. All right, so let me see here. I'm going to try to do that as best I can. I'm trying to look at my, I don't know, maybe you can see that. All right, so if you're kind of looking at the graph here, so the initial issue price is 102, and then over time, the bond is being amortized, which means its carrying value is going down towards 100. So it's going from the premium at 102 down to the par value of 100. And so when this thing is retired, we're kind of out here somewhere. And so now the carrying value is somewhere below 102. And so if I'm going to pay more than the carrying value, there's going to be a loss. Again, I hope that makes sense. Maybe the graph helped a little bit there. I don't know if it did or didn't. So when you convert in the COT, you wouldn't have a gain or loss, but you settle the bonds for cash, a loss or gain results. Yes, if you retire it before maturity, because if you all wait all the way to maturity, you just end up paying the par value out, and the carrying value of the bond is par as well. So the only time you're going to have a gain or loss is if you retire the bond prior to maturity. And Harry, did that graph help you? Good, good, good. Yeah, normally in class I draw that graph. I didn't think to draw that graph here. Normally in class I kind of draw that out there to show that the 102 ends up being a loss. Okay. Stock warrants. So a stock warrant is a right to purchase stock at a future date at a predetermined price. So it's a right. And so people will pay money to have these rights. And so again, the hope is that the price will go up and then you'll have a discount. Basically, that's the idea. But unlike a conversion, with a stock warrant, you actually don't forfeit the security. So if you think about that convertible bond, the holder gave up their bond in order to receive the shares, but they didn't have to pay any cash. With the stock warrant, you actually don't give up any security. Instead, you just pay cash to exercise the option. And so again, what they're hoping is that that predetermined price is less than the market price. And so what you do, let's say that I have a right to buy Microsoft stock at $20 per share. And let's say I pay $5 for that right. All right. Well, what I'm hoping is I pay that $5, and then at some point in time, Microsoft stock is trading at an amount $25 or more. Wouldn't it be great if the stock price went to 30 or 40 or 50? And then what I can do is I can say, well, I'm exercising my right, and I'm turning in my option, and I now get to pay you, Microsoft, I get to pay you $20 per share. So I pay Microsoft $20 per share, and then what am I going to do? I'm going to turn right around and I'm going to sell that share in the market, maybe for $30 or $40 or $50, whatever the market price is at that time. And so that option can end up being very valuable. The downside, of course, is that let's say that I have the option to buy the shares at 20, and let's say that they're trading at 15. Well, that option is completely useless now. So I've paid $5 in this example that I'm kind of talking about. I've paid $5 and it ended up being completely worthless. And so that's kind of the downside of these stock warrants, is you may pay for that right and then end up not being able to exercise it. So there are two types of stock warrants. A detachable stock warrant basically means that the two can be independently traded. What that means is, imagine I have a security, usually a bond, and I have a stock warrant, and they're issued together. Well, a detachable stock warrant means after they're issued, they can be broken apart, which means that the person with the bond can do whatever they want with that bond, and the person with the stock warrant can do whatever they want with the stock warrant. They do not have to go anywhere together. They trade completely separately after the issuance. And so that's a detachable stock warrant, where the two can be detached from each other. Versus a non-detachable, of course, means wherever one goes, the other one goes. And actually, a non-detachable stock warrant is very similar. The accounting is very similar to a convertible bond, actually. So that's a little bit different. We're focused here on detachable stock warrants because we want to kind of understand, when they detach, how do I handle that stock warrant piece? The bond piece we covered in Chapter 14. That hasn't changed. Now we're talking about, well, what do I do with that stock warrant? And that's really what the point of this section is. There are two methods that we can use. So when we have detachable stock warrants, we have to do what's called bifurcation. And so bifurcation means that whatever I receive from the issuance, I have to allocate some of it to the stock warrant. I have to allocate some of it to the bond or the underlying security. So the word is bifurcate. I have to bifurcate the issuance. And so when it's detachable. If it's non-detachable, then I don't have to do that. I just allocate everything to the bond. And so there are two methods that we can use to bifurcate, in other words, to allocate to the stock warrant and the bonds. One is called the proportional method, and the other one is called the incremental method. And so the proportional method is used if the firm can reliably estimate the fair value of both the bond and the stock warrant. So in other words, if I can reliably estimate the fair value of both, then I need to use the proportional method. If, on the other hand, I can only reliably estimate one of the items, then I use the incremental method. All right, so if I can reliably estimate both, I need to use the proportional method. If I can reliably estimate only one, then I use what's called the incremental method. And again, most of this should be in your notes, so hopefully this isn't too difficult. All right, so let's talk about the stock warrant example. Again, this is kind of like digesting a lot of information right away. So you can see this is kind of a lengthy problem. This is in your notes, and so this is not different than what's in your notes. And so we're going to read it, but you don't have to copy anything down, obviously. So a firm issued 1,000 bonds for $1,010,000. Each bond included 10 warrants to purchase the firm's common stock for $20 per share. The firm estimates the value of the bond without the warrant is 98% of the face value, and each warrant has a fair value of $4.50. The issuance takes place on June 30th, 2020. On November 30th, 2021, 6,000 warrants are exercised. At the time the warrants are exercised, the market price for the stock is $25 per share. And then finally, on July 1st, 2022, the remaining warrants expire without being exercised. All right, so we're going to kind of take all this information in and kind of take it piece by piece. All right, so again, whenever we have the issuance, we need to bifurcate the proceeds to the bonds and the stock warrants. Now, since we have, in this problem, a reliable estimate for each of the two fair values, we need to use the proportional method. All right, and so calculate the fair value of each item. Since we're using the proportional method, so let's figure out each one. So for the fair value of the bonds, we're told that it's 98% of the face value, 98% of par value. And so the fair value of the bonds is $980,000. And then we have the fair value of the stock warrants. We're told that each stock warrant has a $4.50 fair value. We also know that there are 10 stock warrants for each bond, and in total there are 1,000 bonds that were issued as part of this issuance. And so the total fair value of the stock warrants is $45,000. So again, the first step in using the proportional method is to estimate the fair value of each item, and that's what we've done here. We have the fair value of the bonds, $980,000, and the fair value of the stock warrants, $45,000. Now, the interesting way to think about this, or at least the way I kind of think about it, is if each of these fair values was precise, in other words, they were spot on, each estimate was 100% correct, then the proceeds that I would have received should have been $1,025,000, because I would just add them up, and that's what I should have received. But for some reason, I only received $1,010,000. Maybe it was a discount that was given because they issued both, or maybe the estimate for the bonds and the stock warrants weren't exactly 100% right. But for whatever reason, these two fair values, while we're given them and while they're reliable, we cannot use them directly for this issuance. And the reason we can't use them directly is because the proceeds that we received isn't the sum of these two numbers. And so since it's not the sum of these two numbers, we need to take a different approach, and that's what we're doing through this proportional method. So the total fair value is $1,025,000, of course, which is different than the proceeds that I receive. And so given that it's different, the second thing that I need to do is allocate the proceeds based on their relative fair value. So we're going to allocate based on their relative fair value. How do we do that? So the allocation of the bonds, remember, we're allocating the proceeds. So we take the $1,010,000, and then the proportion of the fair value that's allocated to the bonds is the fair value of the bonds, $980,000, divided by the total fair value of the bonds and stock warrants together, which is $1,025,000. So that means we're going to allocate $965,659 to the bonds. What does that mean? Well, that means that at least on some level, the fair value of the bond estimate, that 98%, really doesn't reflect this exact transaction, at least not directly. And so instead, we're going to allocate $965,659. And of course, with the bond, that means that there's a discount on these bonds, and that discount balance is $34,341. Now, I'm going to stop there because usually for many students, this is where they get a little bit hung up as far as like exactly what's going on. Again, step one, calculate the fair value of each item, sum the total fair value. Step two, allocate based on the relative fair value. And so that's what this math is trying to do. Again, I'm going to stop there, first of all, because I know I get moving a little too fast, and I want to make sure that you're able to keep up with the calculations, but also give you a chance to ask questions. So again, if you're good, just give me a I'm good, yes, thumbs up, just making sure that we're all on the same page. And if you want a little more time to write some stuff down, just say, hey, hold a sec. The more you communicate, the better I'll be able to kind of pace myself with where you're all at. No problem, Paul. I will definitely hold on. Can you give us an idea of the final journal entry? Oh, absolutely. We're going to get there. Yeah, right now we're just, the biggest with these problems, the challenge really is the calculation. Once you do the calculation, the journal entry, I mean, I'm not saying it's simple, but it's pretty straightforward. But we're definitely going to have a journal entry here in a second. But I just wanted to pause on the calculations to this point. So what I want you all to do, once you've caught up, this will also gauge to see, thanks Aiden, I want you to calculate how much is going to be allocated to the stock warrants. Paul wants me to go over the 450 times 10 again. Oh yeah. So let's go back. Let me go back to the actual verbiage. So if you kind of look, it says in the second sentence, it says each bond included 10 warrants. And so that's where that 10 came from, because each bond can be included with it 10 warrants. And so if you imagine that was two pieces, there's the bond piece, and then there are 10 warrants being issued with it. And so that's where we got that 10. And then the $4.50 is the fair value for each of those. So if you can kind of think about what they're doing is they have 10 different warrants in here, and they're estimating that each warrant is worth $4.50. And so if you kind of add that up, it's basically saying that there's $45 of stock warrants being issued, and $980 for each bond. And so it's kind of what they're thinking is this is worth 98% of par, or $980, and this is worth $45. And so that's kind of what they're estimating. So that's where that 450 times 10 came from. It's the number of warrants per bond, and it's the fair value per stock warrant, which is right here. So it's the $4.50 per stock warrant times 10 stock warrants per bond. So what I want you all to do then is to calculate how much I'm going to allocate to the stock warrants. And so again, type in your answer, and as more and more people are able to get me that answer, then I'll feel comfortable kind of showing and then moving on. So how much are we going to allocate to the stock warrants? $44,341. $44,341. I'm seeing a trend. See if a few more people can get an answer. Alright, I just want one more person to type in an answer. Even if it's the same answer as everybody else is getting. I just want one more person so I can feel comfortable moving on. There we go. We have a taker. Alright, so allocate to the stock warrants, same process. The $1,010,000 times the proportion that we're allocating to the stock warrants, which in this case, of course, is 45,000 over 1,025,000 for a total of 44,341. The other way to think about that is the total issuance is 1,010,000. So if I allocate 965,659 to the bonds, I need to allocate any remaining amount to the stock warrants. Okay, so now to the journal entry. So again, the initial issuance, we are receiving cash. We've been told we received $1,010,000 cash as part of this issuance. Now we're just trying to figure out how much am I allocating to the bond and how much am I allocating to the stock warrant. Again, we said with the bond, we're allocating a total of $965,659, but we know that the par value gets assigned to the bond payable account. And so that means there must be a discount as well. And so that's where, in this case, we have the discount on bonds payable, $34,341, and the bonds payable as a credit of $1 million because that's the par value. And by the way, anytime you have a journal entry, hopefully the bonds payable part of the journal entry is something that you're familiar with at this point. And so as long as you get that right and the cash right, you have a better chance of getting the rest of it right. And then, of course, the other piece is our stock warrants, and the account name that we're going to use in this class is paid-in capital - stock warrants. And so when we have that kind of account, that's the account name that we're going to use. US GAAP does not prescribe that this has to be the account name, but this is one that's very descriptive. So it's separate paid-in capital attributable to these stock warrants. And again, so what's happened is if you kind of think about this from a very theoretical standpoint, people have given our company $44,000 or $44,341 just to have the right to buy our stock. That's what they've done. They've given us $44,341 for a right. So if we kind of go back, it just says, that gives them the right to purchase the firm's stock at $20 per share. So they've paid us for a right. We haven't given them any shares at all. So they gave us cash just to have a right. That right could end up being very valuable to them, or it could end up being worthless to them. It just depends on what happens in the future. And so again, that's the whole idea, that $44,341 represents a contribution that owners have now made for a right. So that paid-in capital stock warrants account, that is an equity account. It's a contributed capital account because people have made a contribution to the company as potential owners for the right to buy stock at a future date. And of course, at the same time, they made a contribution, or they made a loan in the way of this bonds payable. So are the owners paying the market price to get the stock? I will say, Harry, usually, not always, usually the exercise price on the stock warrant is the market price on that day. And so that's usually going to be that price. The strike price is going to be the market price on the day that the stock warrant is issued. Not always, but usually. So just be aware of that. So again, when you say, are they paying the market price for the stock, understand they're not actually paying for the stock. They're paying for a right to buy the stock in the future. Now they're hoping that whatever that strike price is, that it's going to be worth it. Right? That's what they're hoping, but it may or may not be. Does that make sense, Harry? I don't know if I answered your question. Usually I have like a visual, and I can see a facial expression and know like, oh, they got it, or okay, I didn't explain that very well. But just give me a yes, that makes sense, or no, can you explain it again? Yep, I'll hold on, Nate. No problem. Okay, good, Harry. So do stock warrants have a time frame? Yes, usually they expire. Now I will say that's all part of the contract. So like each stock warrant is an individual contract, and even with stock warrants, just so you're aware, there are two different types. You don't have to know this for this class, but just generally speaking, in the U.S., usually it means there's a period of time, and you can exercise the stock warrant anytime you want over that period of time. But usually in Europe, there's a set date where you have to exercise that stock warrant only on that certain date. And so they are a little bit different depending on whether it's an American style option or whether it's a European style option. But usually they do, always there's an expiration date, but that is negotiated for each specific issuance. And then Paul asks, is the price normally that large in real life to hold the price? Is it normally done on that large of scale? So when you talk about these issuances, whether or not the number of stock warrants is kind of realistic or not, honestly, I don't know. I have not participated in these issuances on a regular basis. I will say though that stock option trading, which this stock warrant is a form of a stock option, that is a huge market. Stock options, people, gain and lose, millions of dollars daily trading on these things. So it is a huge market. Now, as far as the proportion of the bond compared to the stock warrant, honestly, that I don't know. And in fact, most bonds are not issued with stock warrants, and most stock warrants are not issued with bonds. And so just be aware that these can be issued together, but typically they're not. But we need to account for it because it is allowable under U.S. GAAP, and it does happen. So Nate says, where did the 10 come from in the fair value of the stock warrants? That came from the second sentence. So it says, each bond included 10 warrants to purchase the firm's common stock. So that's where the 10 came from. Does that make sense, Aiden? Or sorry, Nate? Good. Okay, now, very quickly, just as a FYI, if the company could only have reliably estimated the bonds, which means that that 98% was reliable, but the $4.50 was not, then the journal entry would have looked differently. It would have been, we would have allocated $980,000 to the bonds and any remaining amount to the stock warrants. That's what's called the incremental method. So I just wanted to show you how it would look a little bit different if we had used the incremental method. Again, it's just saying that now the bonds are the only way to reliably estimate this journal entry, and so we're going to allocate $980,000 to the bonds and any remaining amount, which is in this case is $30,000, to the stock warrants. Now again, I just want to be clear that there's not, one is not better than the other. It just depends on what information you have. And so if you have, in this case, if both pieces of information are reliable, then you'd use the proportional method, which is what we see here. And if only the bond information would have been reliable, then this would be the journal entry. And then of course, if only the stock warrant information was reliable, it would look different still. I'm not going to go through that one, but just so you're aware, if we had used the incremental method, the math is a heck of a lot easier, and the journal entry would have looked different. Okay, so let's continue with our example using the proportional method. All right, so then you'd have that bond out there. You'd be recording interest expense and bond interest payments just like you would, any other bond. We've covered that previously. That's chapter 14. I'm not interested in continuing to do that here, but I just want you to be aware that that process is going on. Remember, they're detachable, so the bonds are over here kind of doing their own thing, and now our focus is on what happens with these stock warrants. So when the stock warrants are exercised or expired, that's the next thing that's going to prompt journal entries when it comes to these stock warrants. There's no adjustments, there's no interest payments, there's nothing like that. Basically, we have these warrants sitting out there, and either they're going to expire at some point or they're going to get exercised at some point. And those are really the only two options that we have. All right, so we'll kind of digest this. If exercised, now I just want to be very clear what happens. If the stock warrants are exercised, then the warrant holder must return the stock warrant. So imagine they have like this slip of paper. It's probably electronic at this point in time. But they have this slip of paper and they say, okay, I want to exercise my option. I want to exercise this stock warrant. Here's the warrant, but they also have to pay. Remember, they had a right to buy the shares. So they still have to pay for the shares. And remember that predetermined price in our example was $20 per share. So they have to give them a piece of paper, and they have to give them $20. And in exchange, the company gives them shares. So they say, here's my stock warrant, here's my $20, and the company says, thank you very much, here is your share. So there's this exchange, the stock warrant in cash in exchange for a share of stock. And so that's how that exchange takes place. Now, in this example, it doesn't matter what the market price is. It doesn't matter what's going on. This is a contract between the stock warrant holder and the company. There's been an agreement. And the agreement is when you turn in that piece of paper and $20, I will give you a share of stock. And so whenever the company fulfills that option, in other words, fulfills their end of the bargain, which is giving them a share, there's really two ways they can do it. They can either issue new shares or they can reissue treasury shares. That's, either one is fine. The holder of that stock warrant, they don't care whether it's a new share or whether it's from treasury. They just want their share of stock. They're saying, here's my stock warrant, here's my $20, give me a share. All right, and so that's kind of what happens. So if exercised, the firm will issue new shares or they can reissue treasury shares. And then finally, if they expired, then the contribution from the stock warrants is reclassified. So the whole idea here is thank you for your contribution for having the right, and also thank you for not exercising that right. So essentially the company gets free money because they didn't have to give them anything. They just had to give them a right, but it ended up costing them nothing in terms of shares or anything like that. But the fact is, there is a difference from an accounting perspective from a stock warrant that can still be exercised and a stock warrant that can no longer be exercised. So there's basically like a reclassification that has to happen whenever the stock warrant expires. So if you can hopefully you kind of envision what's happening here. So you have a stock warrant holder either exercising their stock warrant or allowing it to expire. And the accounting is kind of hopefully, I don't want to say obvious, but hopefully easier if you can kind of envision what's happening. So let's talk about the exercised stock warrants on November 30th, 2021. Remember, they have to turn in the stock warrant and they have to give them cash. And so so again, in this case, at expiration, do they recognize a gain? No, they do not. So there's no gain or loss. You're just reclassifying the contribution. Remember, from the perspective of the company, that right was basically a contribution that owners make. So just like any other contribution, it's not a gain or loss. It's just a contribution. So owners made contributions to have the right. So there's no gain or loss. What happens if all the stock warrants expire without being exercised? Then all of them would be classified as a permanent contribution. That's it. So the company would have received $44,000 plus some change just for giving some people the right to buy their stock. And since they never exercised that right, then it's just a permanent contribution. So now in this case, we're talking about them actually exercising those warrants. And so again, the two things they have to do, they have to turn in the stock warrant and they have to give them $20 cash. And in exchange, the company will give them the shares. And so again, on this date, we are told 6,000 stock warrants are exercised. And so what that means is the company is going to receive $20 for each share that's going to be issued as part of this exchange. And so each stock warrant is one share. It's kind of straightforward. Each stock warrant is one share. And so I'm going to be issuing 6,000 shares. They're going to be exercising 6,000 stock warrants, which means they're going to give me $20 for each one. And so that $20 times 6,000 shares means as a company, I'm now going to receive another $120,000 cash. So previously, they made a contribution to have the right. Now they're making a contribution to exercise that right. And so with the stock warrants, we kind of have to think about, okay, what does it mean, or what's the value of that piece of paper that they're turning in? Remember, whenever we had the issuance, if we kind of go back, we had assigned $44,341 to that paid-in capital stock warrant account. So we're saying that contribution, the value of that contribution is $44,341. Well, what does that represent? It's $44,341 for all of the stock warrants. Let's go back and figure out, well, how many stock warrants are there? Go back. $10, so there's 10,000 stock warrants in total. 10 stock warrants per bond times 1,000 bonds. And so that means we have $44,341 allocated to 10,000 stock warrants. which means that each stock warrant, we've assigned a value to each stock warrant equal to $4.43. That is the value that we as a company have assigned to each stock warrant. And so when someone turns in that stock warrant, we have to take that amount off of our books. So the $4.43 per stock warrant, we multiply it by the 6,000 stock warrants that are exercised, which means we're going to change that account. We're going to decrease that account. We're going to debit that account $26,580. Again, we're reducing the paid-in capital stock warrant account because they're turning them in. The paid-in capital stock warrant account represents options, outstanding options. Well, now these stock warrants are no longer outstanding, so we need to reduce that account balance. I'm going to slow down there just to make sure we're all caught up. So again, they turn in their stock warrants at $4.43 per stock warrant, and they give me $20 in order to get those shares. So the kind of two things that they're giving me, and in exchange, what am I giving them? So that's what they're giving me. Cash in and turning in those stock warrants. And then, of course, I am issuing them common stock. The common stock has a $1 par value, so that's what we assign to the common stock account. And then the APIC common stock account is just the plug to complete the transaction. Again, I'm going to stop there. In case there are any questions. Is everybody doing okay? All right, I'm going to kind of move forward here. All right, so now the expiration. The original balance for the stock warrants was $44,431. Of that amount, $26,580 had been exercised, which means that after they were exercised, the remaining balance was $17,851. And so when the stock warrants expire, that is the account balance that is going to expire. Now, since they expired, there's no cash, there's no issuance, there's nothing. They just basically, imagine they have those pieces of paper and they just light them on fire. They just disappear. And so from an accounting perspective, really nothing of economic consequence has happened to our company. Because the fact is somebody paid for the right, that right expired, so we really haven't changed in any real way. But we do need to reclassify that information. And so what we're going to do is we're going to take the paid-in capital stock warrant account off the books and replace it with this more permanent account called paid-in capital expired stock warrants. Again, US GAAP doesn't prescribe that this be the account name, but it's the one that makes sense because you're searching for an account name to describe the difference between having this outstanding stock warrant and having sort of more of a permanent contribution from an expired stock warrant. And so that's why we changed the account name. So now the stock warrant account is off of our books and it's replaced with the expired stock warrant account. Again, hopefully that part of the journal entry is not too difficult. Okay. Stock compensation. There are two types of stock compensation that we're going to be talking about, stock options and restricted stock. And it's really a form of deferred compensation to our employees. And so what happens is the employee earns the benefit of the option as they work. In other words, they work now, and in exchange for that work, they either get a stock option or they get restricted shares. But they don't really get to exercise that option, or they don't get to actually sell those shares until somewhere in the future. So in other words, from their perspective, it's kind of a form of deferred compensation. I work now for a benefit that's going to come later as the employee. So they're earning the benefit now, but receiving the benefit later. So it's really a form of deferred compensation. But from the firm's perspective, using the matching principle, they have to match the compensation expense to the benefit that the firm receives. In other words, if you're working today, I need to match the expense related to that work today. I can't wait to do that. And so because of the matching principle, we need to figure out a way to record the compensation expense as the person is working. And so basically that employee is going to work through this vestment period in order to earn that stock option or earn that restricted stock, and we need to match the compensation expense to the work that they're performing. And that's sort of this idea then is, if you really want to get technical, every second they're earning a portion of that, but it doesn't make sense from an accounting perspective to record a journal entry every second. And so typically they're going to periodically update the compensation expense to reflect the portion of this stock option or restricted stock that they've earned. And from our class's perspective, we're only going to make adjustments at the end of a fiscal year. We're not going to do it monthly or quarterly or anything like that, although a company could do that if they wanted to. But again, they're kind of earning that continuously, and we're going to record the compensation expense periodically in order to apply the matching principle. Again, this is all in your notes, so hopefully that's not too difficult to follow. What are the benefits of stock-based compensation? The big one is the firm saves cash. If you think about it, like as a company, I can say, well, here's some shares of stock, but if I don't give you shares of stock, I got to give you something, and that would be cash. And so it does free up cash. I think it was Michael Eisner, who is the Disney CEO. For years, his annual compensation from Disney was $1 in cash compensation. $1. Everything else was stock options, and people estimate that he made hundreds of millions of dollars in stock options. Because basically he would get these exercise prices that were fairly low, and then the Disney stock was climbing like crazy, and so those options became incredibly valuable. But the company didn't have to pay anything for that. They could issue new shares to fill it, that kind of stuff, but basically it saves them cash because they can just issue new shares to cover that stock-based compensation. It does align shareholder and manager incentives. In other words, if I as a manager am kind of looking at this and saying, well, okay, all of my income or a large portion of my income is caught up in the share price, basically with a stock option or restricted stock, as that share price goes up, the value of my compensation goes up right along with it. Well, obviously this is something that the shareholders want as well, because they just want the stock price to go up. So Nate says Elon and Tesla was doing the same thing by taking mostly stock as his annual salary. Absolutely. It's crazy how much money they can make through this stock-based compensation. Issuing new shares is expensive, I thought. Other than the cost, how do I put it? In this situation, it would not be. And the reason why it would not be is because there's no need for an investment bank or anything like that. So it's not like an IPO. That's probably what you're thinking of, Harry, is like an IPO, where you're kind of having an initial public offering, you're having to employ an investment bank, you're having to make a market for your stock, and that process can be fairly expensive and difficult. But what we're talking about here is really small transactions in the grand scheme of things. We're talking about just issuing shares to my employees. So there's no investment bank. There's just a matter of basically getting the board's approval to issue the shares. Well, guess what? The board approves the compensation for the CEO, so they approve the manner in which you're going to compensate them, which would include issuing new shares. I will say, however, as a caveat, Harry, if the company has to obtain the shares through treasury stock transactions, then it actually could be very expensive for the company in terms of using cash. So they may have to use cash in order to get the shares if the board will not approve issuing new shares. If the board requires that the company use treasury shares, then it could get very cash heavy for the company to fulfill. But again, that's not a requirement, because you can just issue new shares, and that can be done in terms of like to an employee at a fairly low cost. So again, the second piece of that is that now both the manager and the shareholders benefit from stock price appreciation. And the other thing too is when you have vestment periods and things like that, the executives are more likely to stick around, because if you have a lot of stock-based compensation that has not yet vested, it's very unlikely that you would want to leave because you would lose out on those shares. So currently, stock-based compensation is the single largest component of officers' pay in the S&P 500. The S&P 500 is, 500 of the largest stocks in the U.S. So this is a big deal. Under current U.S. GAAP, the FASB requires what's called the fair value approach for stock-based compensation. So basically what it means is that the issuing firm uses the fair value of either the option or the restricted shares on the grant date, and then after that they make no adjustments. So the fact is, like, share price changes every day, as do the value of stock options. Under current U.S. GAAP guidance, we do not make any adjustments. In other words, you take the fair value on the day that the option is granted or on the day that the restricted shares are issued, and then we don't touch it after that. There are many professionals who think that we should be making adjusting entries. That may come down at some point in the future, but right now we don't do that. All right, so what does a stock option look like? So now getting more specific to a stock option. So employees receive the right to purchase shares at a future date at a predetermined price. Usually that price is the stock price on the date that the option is granted. It doesn't have to be, but that's usually what it is. And so in other words, now basically I as an employee say I will work, and all I ask in return, or partially what I ask in return, is for you to give me the option to buy shares at a future date. And those share price, that's a negotiated item, but usually it's going to be the stock price on the date that the option is granted. And so in their minds, they're like, okay, so today the shares are trading at $25. If I do a good job, maybe the shares are trading at $40 a year from now, or 2 years from now, when I can actually exercise that option. I can make a boatload of money. And so that's the whole idea of aligning those incentives. So the right usually includes a vestment period after which the employee can exercise the option. That vestment period is also a point of negotiation. It could be a year, 2 years, 3 years, 5 years, who knows. Obviously, the longer the vestment period, the less valuable the option would be to the employee. The value of the options is compensation expense, and it's allocated over the vestment period. And so the idea is you have the value of these options. We're going to record that compensation expense, and the method we're going to use is basically a straight line allocation over the vestment period. I will say that if it's like a ladder vestment or things like that, it can look a little bit different, but we're going to kind of keep a simple example for this class. So under the former intrinsic value method, the firm records compensation expense as the difference between the market price and the exercise price. And actually, back when Disney had this arrangement with Michael Eisner, this is the approach that they used, the intrinsic value method. Well, the only problem with this is that, as I say in the first bullet, usually the stock price and the exercise price are the same. And so under the prior method, which was the intrinsic value method, most of the time stock option based compensation expense was zero, because there was no difference between the strike price and the market price at the time the stock option was issued. Under the new method, which is the fair value method, now there will be some sort of compensation expense, and this is a vast improvement over the intrinsic value method. Again, the firm has to estimate the fair value of those options. There's lots of different ways to do it. There's like Black-Scholes and different things. For this class, you're always going to be given the fair value. You're not going to have to figure out how to estimate it on your own. There are also a lot more complex assumptions that the company can make, which might alter the compensation expense, the timing of it. All the assumptions don't really change the total amount of compensation expense. It just kind of might affect when you record it. For this class, though, we're not going to introduce those complexities. In real life, though, you will have to deal with them. All right, let's kind of walk through an example. So 49er Company employs 75 executives, where each is granted 500 stock options on January 1st, 2020. The options allow the executives to purchase the stock price at $30 per share at the end of the 3-year investment period through December 31st, 2027. So in other words, there's a 3-year investment period, and at the end of that investment period, there's a limited window when they can exercise those options. It's called a cliff vesting arrangement, which basically means that if they quit, one day before that 3-year investment period is up, they get nothing. It's very common to see a cliff vesting arrangement. Probably the most common, though, is where if it's a 3-year investment period, they'd have like a third vest after 1 year, another third vest after 2 years, and another third vest after the 3rd year. If it's that kind of arrangement, the way that we record compensation expense would be a little bit different. This is just the simplest one for learning this concept the first time. The fair value of each option is $6.50, and the market price at the time the options are granted is $35. So that $35 really is just thrown in there as noise. It's not really relevant to anything we're doing, but it's just to kind of illustrate that there is a market price, and you need to be, as an employee, you'd want to be aware of that. All right, so some more information. So all 75 employees were still with 49er as of December 31st, 2020. Some employees leave on July 10th, 2021. Everybody else is still around. And then some more employee leaves on August 1st, 2022. And then the remaining 64 employees remain with the firm through December 31st. In other words, the remaining 64 fully vest. And so basically, if you kind of imagine, when we issue these stock options, we don't know who's going to stay and we don't know who's going to go. And so while I have information right now about who's going to stay and who's going to go, at the time I issued the options, I don't know that. And even at the end of December 31st, 2020, I don't know who's going to stay and who's going to go. And I don't know, every year you don't know. So while I give you all the information here, you really have to walk through it sort of step by step on what did they know at the time and how would that inform the journal entry that they're going to record. And so that's the whole idea here. Again, all this information is in your notes, so you shouldn't have to copy it all down. All right, so at the time the options are granted, so on January 1st, 2020, the company would probably have a memorandum, but that's it, because really nothing has happened. If you kind of think about it, like the employee has not given the company anything. The company has not given the employee anything. They've just come to an agreement. They've entered into a contract. And so there might be like a memorandum, like, explaining the terms of the stock options, but there's really no journal entry. Technically speaking, as soon as the employee starts working, now something of economic consequences happened, because now they've started to earn those stock options. So again, as I said before, theoretically, I could start recording the compensation expense every second of every day, but as a practical matter, we're going to wait till the fiscal year end to accrue it. And so our first entry is the December 31st, 2020 adjusting entry. So we know that the total compensation expense related to these 75 executives, that's kind of the first step in this, and say, well, okay, what's the value of what we've agreed to in this contract? Well, we have 75 executives. Each executive gets 500 options, and the fair value of each option is $6.50. What does that mean? Well, it means that the value of all of these options is $243,750. And if you think about it another way, what we've really done is we've said, okay, the compensation expense associated with these stock options is worth $243,750. That's the value of the work that they're going to do in order to get these options. That's what we estimate the value to be. Now the question is, how much of that do we recognize on December 31st, 2020? Remember, this is a 3-year investment period. And so we're saying, well, at the end of 1 year, how much do we recognize? And hopefully by now it kind of makes sense that we're going to allocate 1/3. So what we do is, with a 3-year investment period, it's 1/3, 1/3, 1/3. If it was a 5-year investment period, it'd be 1/5, 1/5, 1/5, it'd be 1/5 every year. And so because it's a 3-year investment period, we use 1/3, and that's what's going to be allocated to 2020. And so the amount that we allocate is $81,250. And so a journal entry then is we record the compensation expense is $81,250. The other part of that transaction is this account called paid in capital dash stock options, $81,250. Now I want us to think about this account because for some students it's like, okay, what is this account and what does that mean exactly? And so normally what would happen is if an employee worked and we compensated them, they would get cash. And that cash would be, in this case, $81,250. So we'd be reducing an asset, essentially, to cover this compensation expense. But in this case, they're not working for cash. And in some ways, if you want to think about it, they're not really working as employees. They're really working as an owner. In other words, they're making a contribution to the company. And that contribution is worth $81,250. So if you think about it, really what they're doing is they're working for ownership. And so that ownership component, the idea that they're working as an owner, is a contribution. It's a contributed capital account. And so this paid in capital dash stock option account basically is trying to capture the fact that we have employees who are working for a right to buy stock. And so those employees are working, they're making a contribution as an owner. And that contribution is giving them a right. And so that paid in capital stock option is how we capture that account. Again, sometimes it's a struggle to understand why we're using that account, but I hope that makes sense. So Will, where did the 1/3 come from? The idea here is it's a 3-year vestment period. And so we're going to allocate the compensation expense over the 3 years. So the total compensation expense needs to be allocated over a 3-year period. So we allocate 1/3 to 2020, 1/3 to 2021, and 1/3 to 2022. Hopefully that makes sense. And again, if it had been a 5-year vestment period, it'd be 1/5, 1/5, 1/5, 1/5, 1/5, if I did the number right there. Okay, let's see if we can move on this. All right, so the next event is that on July 10th, 2021, some employees leave the company. So how do we handle that? If you think about it, on 12/31/2020, we recorded a compensation expense for all 75 executives, acting as if all of them were going to stay for the 3-year period. And so basically we've done some accounting. We've recorded something of economic consequence, making an assumption. That assumption is that all 75 executives are going to stay. And so all of a sudden now, not everybody stays. And in fact, we're told on the previous page that 8 employees leave on this date. And so all of a sudden, 8 out of our 75, basically this was wrong. This journal entry on 12/31/2020 ended up kind of being wrong because 8 executives left. And so this compensation expense that we recorded for these 8 executives, it actually wasn't an expense. We didn't incur any cost. There's nothing that really happened because they left. I don't have to give them shares, nothing. We're good. And so what happens then when they leave is we need to kind of undo anything that we've recorded of any kind of economic consequence related to these 3 employees. And so we have to think about, have we previously recognized any compensation expense for these employees? And the answer is yes, we have. And so we have to think about, well, what is that amount? What had we recognized? Well, those 8 executives each had 500 options. The fair value of each option was $6.50. And as of this date, July 10th, 2021, we had previously recognized 1/3 of that total value. And so in other words, we had recognized $8,667 in compensation expense related to these employees. And at the same time, of course, we had recorded a contribution that paid in capital stock option account in the same amount, $8,667. And so now we need to undo it. We need to act as if we needed to act as if that compensation expense was never incurred and the contribution was never made because they're not going to be owners. And so basically then we have to credit the compensation expense and we have to debit the paid in capital stock option account. Basically we're undoing the previous adjusting entry just for those 8 executives. Again, for these kinds of problems, it's really important that you keep track of each executive. How many options does each executive have? What is the value of each option? how much have we recognized? Has it 1/3, 2/3? How much have we recognized? And so that's kind of the idea behind this journal entry is when somebody leaves, we have to undo everything. And so we're undoing that journal entry. Again, for most students, this is a bit of a challenge, but hopefully you're starting to see what's happening here. We recorded as if they're going to stay for the full 3 years. They didn't, and so now we have to undo it. Just making sure there are no questions. Okay. So now we come to the end of the next fiscal year. So at the end of 2021, again, in this case, we're down to 67 executives. Remember, before we had 75, but 8 left. And so now we're down to 67 executives. Each of the remaining executives have 500 options, and the value of each option is $6.50. So the total compensation expense for all 67 executives is $217,750. Well, how much should we allocate to 2021? Just like we had previously done, we always allocate 1 over the vestment period. And so in this case, we allocate 1/3 to 2021 for a total of $72,583. And of course, the journal entry then is a debit to compensation expense for $72,583 and a credit to paid-in capital stock options for $72,583. Again, this is the adjusting entry at the end of 2021 to record the compensation expense for the remaining 67 employees. Now, one thing I want to highlight here is that there are 2 components to compensation expense in 2021. There's the compensation expense debit that we recorded here on 12/31/2021. But we need to subtract off, if you think about the prior journal entry, we had credited compensation expense $8,667. And so the net compensation expense is $63,916. This is what would be recorded on the company's financial statements. They would record the $63,916 as the total compensation expense for these stock options in 2021. Again, the adjusting entry amount minus the departure in July. All right. So now we have more employees leaving on August 1st, 2022. Again, we have to think about what have we previously recognized in terms of compensation expense. It's a little bit different this year. And the way it's a little bit different, again, it's 3 employees instead of 8. That's one difference. Each employee has 500 options, and the fair value of each option is $6.50. But notice that in this case, multiply by 2/3. And the reason that we multiply by 2/3 is that we had recognized compensation expense for these 3 employees at the end of 2021. At the end of 2020. And at the end of 2021. So we've recognized 2/3 of their compensation expense in the previous 2 years. And so now that they're leaving, we have to undo 2/3 of their compensation expense. And so the 3 executives times 500 times 650 times 2/3 gives us $6,500. And so again, in this case now we're undoing what we had previously recorded. So we're taking the paid-in capital stock options off the books, and we're taking the compensation expense off the books as well. $6,500 for each. Again, I'm hoping this one's not too bad. So then the adjusting entry at the end of the year. There are 64 executives who are left. Again, 500 options for each. $6.50 is the fair value for each option, for a total of $208,000. What we're going to allocate to 2022, of course, is 1/3 of that, $69,333, which gives us our journal entry of $69,333 as the debit to compensation expense and as a credit to our paid-in capital stock option account. Again, I'm hoping by this year's adjusting entry, the calculations make a lot of sense. And similar to 2021, the amount of compensation expense recorded is our adjusting entry amount minus the previous entry in August of $6,500 for a net compensation expense of $62,833. So hopefully all that makes sense. Again, I'm going to give it a second here to make sure that everyone's kind of keeping up. All right. Now just a bit more information to kind of tie all the loose ends together. So ultimately we have to think about what happened over the 3-year period. And really ultimately what happened is there were 64 employees that worked for the entire 3-year period. So only 64 employees actually vested in these stock options. And so really if you think about it, that means ultimately at the end of the day, the compensation expense over the 3-year period was $208,000. So how much did we report each year? In the first year, we reported $81,250. In the second year, the net amount that we reported was $63,916. And then finally in 2022, the net amount that we reported was $62,833. Absent some rounding, that gets us to $208,000 total. So in other words, the timing is a little bit different. In other words, we didn't recognize exactly 1/3 every single year because some employees left. But in total, we had incurred $208,000 of compensation expense, and we recorded $208,000 of compensation expense. It's just because of the timing of when employees left, the amount each year wasn't exactly 1/3, 1/3, 1/3. And it never will be unless you perfectly predict who's going to stay and who's going to go, and you can't do that. All right, so now continue with the previous example. Let's say that 60 of these executives, of these 75 executives, exercise their options immediately after they're vested. We're going to assume that the firm issues new shares to fulfill the stock options. So again, in order to exercise their options, each employee must pay $30. And so we have the 60 executives exercising all of their 500 options, and each of them must pay $30 per option. That was part of the contract. And so they have to pay the company $900,000 in order to exercise their options. Now, of course, they would do this if the market price of the options was above $30, because then you just basically pay the $30 and turn around and sell it for more. But they do still have to come up with the cash to pay this $900,000. At the same time, of course, we have to take the paid-in capital stock option account off of our books, because that stock option account is capturing outstanding options that continue to exist. And of course, these, since they're exercised, no longer exist. And so you take the 60 executives, multiply it by the 500 options per executives, and of course, the fair value for each option was $6.50. And so the journal entry for the paid-in capital stock option account is $195,000. And so the first part of that journal entry then is the cash that the company is going to receive. We're taking the paid-in capital stock option off of our books, $195,000. And of course, we're told that we're going to issue new shares. And so the common stock account is going to be the number of shares times the par value. So, 60 executives times 500 options means that they're going to each get 500 shares. And so it's 30,000 shares. The par value of the common stock is $1 per share, so we're going to record a $30,000 credit to common stock. Any amount above that goes into APIC common stock, and again, that APIC common stock ends up being a plug in this journal entry. So again, calculating the cash that's going to be paid by the employees to the company, calculate the amount that we need to reduce the paid-in capital stock option account by, and then record the issuance of the common stock. Again, I'm hoping that by the time we get to the common stock part of the journal entry, that's fairly straightforward. So now let's assume that the remaining options expire. And so again, we have to think about what's the balance in the account. Well, again, the original balance or the full balance was $208,000. We already had taken off $195,000, which means the remaining balance is $13,000. And similar to our stock warrants, you basically want to record this transition from a temporary equity contribution to a permanent contribution. And so that's why we take the stock option account off of our books and put onto our books this expired stock option account. Again, just to signify that these stock options are now expired, and then these employees essentially worked for nothing because they didn't end up exercising their options. I'm hoping this one's not a difficult journal entry. Okay, so now let's talk about restricted stock. For restricted stock, basically these are shares that actually get issued to the employees, so this is important. They actually issue these shares to the employees, but the employees can't do anything with them until after a blackout or vestment period. Usually, by the way, these shares are held in a trust, and the trust has very specific legal terms around it that basically the employer can put shares into the trust, but they cannot take them out. Only the employee can take them out after the vestment period. Now, if the employee leaves, usually there's something in the contract that says that the shares would be returned then to the company. But it's a little bit different in that rather than having an option, they're actually receiving shares. And so the benefit to the employee is they actually don't have to pay any cash in exchange for these shares. They just get the shares straight up. They don't have to pay for them. Absent bankruptcy, the shares will have some value. Remember, the only reason the option had value is if the exercise price remained above whatever market price there was. These are a little bit different in that since you have the shares, as long as the shares are being traded, they have value. Now, obviously, if the company goes bankrupt, the shares aren't going to be valuable anymore. But absent that, they will have at least some value. The nice thing, too, for the shareholder is that restricted stock usually results in less dilution. So in other words, for the same work, a company would have to give the employees way more options than they would have to give them restricted shares. Again, because the options require that the employee actually pay cash and there's a lot of risk, whereas the restricted shares is just, here's your shares. And so usually there's going to be a lot less dilution for existing shareholders if you use restricted stock. And for that reason, by the way, restricted stock is becoming a more common form of compensation, even over stock options. So let's walk through an example. So they grant each of its 50 executives 125 restricted shares on January 1st, 2020. At this time, the market price is $22.50. The shares vest in 2 years and only vest if employees remain, so it's a cliff vesting arrangement. And there's a par value, 7 employees leave, on and on we go. All right, so let's kind of walk through this example. So first of all, we do have to record the issuance. Because I'm actually issuing shares, there is something of economic consequence that happens whenever they have the grant date. So on that January 1st, 2020, there is actually a journal entry that we need to account for. And so this unearned compensation is a new account. And what it's meant to capture, it is a temporary contra equity account. So it's kind of a weird account. It's a temporary contra equity account. And basically what it's doing, it's a placeholder, for lack of a better phrase. It's a placeholder. And what it's saying is we've issued some shares. In this case, 50 executives, each have received 125 shares. The fair value of each share is $22.50, which means the total value of the stock that's being issued is $140,625. However, the employees don't have any rights to these shares. And so in reality, while I've issued the shares, I haven't quite diluted my shares yet. So in other words, they're kind of sitting there, but they're kind of not sitting there. And so what this unearned compensation account does is it kind of offsets the issuance. And so the idea here, if you kind of take this a step down, is we're going to issue the common stock. And so 50 executives, 125 shares per executive means we're going to be issuing 6,250 shares. So that's the amount that we credit the common stock account for. The value of these shares is the fair value, the market value, $20.50. We assign that full value to the unearned compensation account, and then the APIC common stock becomes a plug. But what this unearned compensation account does is, again, it's a temporary equity account, and when combined with this common stock account, it essentially nets it out. And so initially on the books, the equity of the company has not changed. But over time, as employees start to work, what you're going to see is you're going to see retained earnings go down because of compensation expense. And basically then you're going to see that unearned compensation start to go down at the same time, which then is going to allow basically the contributed capital to increase. And so what you're going to see is, if you could imagine, at the initial issuance, there's no change in either earned capital or contributed capital. They're going to look exactly the same. And then essentially, as the employee works, earned capital goes down and contributed capital goes up. And it just kind of goes this way. And so again, total equity doesn't change, but the form of equity is going to change as the employee works. And so that unearned compensation is the contributed capital account, whereas the retained earnings is the compensation expense ends up being the earned capital account. And so again, the compensation expense reduces earned capital, and at the same time, the unearned compensation gets reduced because it's a contra equity account, and that's going to increase contributed capital. And so again, the idea is the companies are, or the employees are working and they're making a contribution. So their contribution as owners to the company is their work. And so we're trying to record that fact. Again, this is restricted stock is kind of new territory for most students, and understanding that unearned compensation account is really important. It's a temporary contra equity account that's meant to sort of sit in that contributed capital account. But the company did not get any money. How can they increase contributed? So again, you're correct, Harry. They're not getting money, but they are getting a benefit. The employees work. Exactly, Harry. It's because the work has economic value. 100%. Spot on. Great observation. Harry, that's exactly what I'm trying to say. So I think you're right on track. Okay, so we've issued the shares. We have this temporary equity account. Okay, now as we move forward, some employees leave. So, first of all, when that employee leaves, the shares are going to be returned to the company. All right, so in other words, that common stock, again, those 7 executives leave, they have to return the shares. They'll come back out of the trust, back into the company. And so the 7 executives, $125 per executive, or 125 shares per executive, and the par value, of course, is just $1 per share. So the common stock account needs to be debited $875. The APIC account, we know we had originally credited that account for $21.50. Again, the total market price was $22.50. $1 of that is allocated to common stock, and the remaining $21.50 is allocated to APIC common stock. And so we have to debit our APIC common stock account $18,813. So the return of the shares is the first part of that entry. That's the shares coming back out of the trust into the company's possession. Now, the second half of that then is we need to unwind, that's the term I use, we need to unwind any unearned compensation or compensation expense related to those shares. Now the way to think about it is when those shares are issued, the offsetting piece of that then is either it still sits in unearned compensation or it's been recorded as compensation expense. It has to be in one of those two states. Now, as of June 1st, 2020, we have not recorded any compensation expense, which means that the value of those shares is all captured in our unearned compensation account. And so none has been recognized as compensation expense. So that means of this total amount of returned shares, all of it is going to come from our unearned compensation account. So then the journal entry then is an $875 debit to common stock and $18,813 debit to our APIC common stock account. And again, we're unwinding the unearned compensation expense for the total $19,688. Again, these are for those seven executives that left. The reason we have to record it is because we had recorded the issuance and recorded this unearned compensation for each of those 7 employees. So now we come to the end of the fiscal year. So again, it's a 2-year investment period. So now basically what we're saying is, okay, we're kind of here, right? And I talked about, so over time we have this happening. So really this process is continuous. But at some point in time we're going to stop and record it. And since it's a 2-year investment period, about halfway through, we're going to stop and we're going to make an adjusting entry to record this transition from compensation expense between unearned compensation and compensation expense. And so at the end of the first year, we need to record half of it. Now, of course, we do know that 7 executives have left, so there's only 43 executives that remain. Again, they each have 125 shares. The fair value of each share is $22.50, and again, we're recording half of this movement at the end of 2020 for $60,469. So then the journal entry, we record the compensation expense as a debit, and again, we're unwinding the unearned compensation, $60,469. And again, that unearned compensation, just again as a reminder, it is a contra equity account. So as that account gets smaller, which is a credit, the contributed capital is going to get bigger. So it's moving like this. The retained earnings ultimately through compensation expense is going down, and the contributed capital is going up. So another employee leaves. So we got to record the return of the shares. So again, 4 executives, 125 shares, $1 per share for $500. The amount above the par value is our APIC common stock account. Same calculation as we had done before, but instead of 7 employees, of course, it's only 4 employees. So we're returning the shares out of the trust. Then the second half of that is to unwind our unearned compensation or compensation expense. Now this year it's a little bit different in that we have recorded some compensation expense. And basically, if you remember, we've done half. And so what we're saying here is when we unwind, half of this amount is still in unearned compensation, and the other half is in compensation expense. Now, if this had been a 3-year investment period, then 2/3 would still be unearned, and 1/3 would be earned in this compensation expense. And so it just so happens that because this is a 2-year investment period, it's half and half. If it had been 3, it'd be 1/3, 2/3. If it had been 4, it'd be 1/4, 3/4. You know, it just depends on where we are. But again, this is a simple example where it's half and half. So half has been recognized as compensation expense. So the other half is still unearned compensation. So then in our journal entry, we take that full amount and we allocate half of it, or basically half of it then comes out of unearned compensation, and the other half goes as a credit to compensation expense to basically unwind the previous compensation expense that we had recorded. So I'm going to stop there in case anybody has any questions. Okay. So now the December 31st, 2021 adjusting entry. We're going to recognize again half of the unearned compensation as compensation expense because this is the second year of the 2-year investment period. There are 39 executives that still remain. Half of their total compensation is $54,844. And so we need to recognize that as compensation expense, and of course then that reduces any remaining balance in our unearned compensation account. Now for restricted stock, we're done now. Basically now those shares have fully vested. The executives can do whatever they want with them, and it doesn't affect us at all. They're their shares. They're owners now. They can do what they want. They're just like any other shareholder at this point in time. Okay. Now, normally in this is kind of when I would normally probably have ended a lecture, and I would kind of do earnings per share on in the next lecture. It's 11:30. We haven't quite gone 2 hours. Personally, I would just like to keep pressing. So hopefully y'all can hang in there. If your tank is empty or whatever, that's fine. You're not going to offend me if you decide that you're going to kind of watch the rest of this later. But I'd like to keep pressing personally. I wasn't sure if my voice would be shot by this point in time, but I feel like I can keep going, so I'm going to go ahead and keep going. Hopefully y'all can hang in there too. But earnings per share is kind of a new topic, so if you kind of think about everything we just did, these might be important kind of things to think about going into this next topic, but really earnings per share is kind of a separate thing. So basic earnings per share captures earnings per share absent any potential dilution. And so when we talk about dilution, really what we mean is that there are contracts that could cause the company to issue more shares. And so when you talk about earnings per share, what it's basically saying is something could happen to that denominator, and so that's what we call dilution. But with basic EPS, we're essentially ignoring any potential dilution. It's kind of the simple form of earnings per share. It's probably the one, if you've studied it before, it's probably the one that you've already calculated, at least on some level. So we have some information that's part of our basic earnings per share. There's the income available to common shareholders is kind of the numerator. And then the denominator is the weighted average common shares outstanding. So this is the technical way that we calculate earnings per share. It's very specific because when we say the word earnings, we can mean a lot of different things. So we're very specific. Income available to common shareholders. And then we say shares. That can also mean a lot of things. And so in US GAAP, when we say per share, what we mean is per weighted average common share outstanding. It's a very specific calculation. So diluted earnings per share then is basically the same calculation, but now we have to include any potential dilution from these outstanding contracts. And there are three forms of that: employee stock options, convertible bonds, and convertible preferred stock. So all these things can potentially dilute earnings per share. And so when we talk about diluted earnings per share, we're accounting for these additional factors. All right, basic earnings per share. So let's calculate the firm's basic earnings per share given the following information for 2021. On January 1st, the firm has 100,000 common shares issued and outstanding is what that should say, issued and outstanding. Then some stuff happens. So we issue additional shares. There's a 10% stock dividend. There's a repurchase. There's a split. All kinds of things going on. So basically this calculation is everything that can happen happens. On a test, you're not going to have this much going on. But just so we can kind of see everything illustrated, we're going to walk through this basic earnings per share calculation, and this is about as complex as it can get. We also need to know the income. We need to know any preferred stock, all those kinds of things. And so this is just extra information to complete our calculation. All right, so the numerator, if we're talking about income available to common shareholders, that is net income minus any preferred stock dividends. Now, it does not matter whether the preferred stock dividends have been declared, because the fact is the preferred shareholders have a right to those dividends before common shareholders have any right to income. And so we take the net income that's been reported, $500,000, and we subtract the preferred stock dividend from the problem. We can see that the preferred stock, it's called 7% preferred stock, which is the dividend rate, and we apply that to the par value of $100 per share. And so 7% of $100 is $7, and there are 5,000 of those shares. And so 7% of 100 is $7 per share times 5,000 shares is $35,000. And so the net numerator is $465,000. So that's the numerator of our basic earnings per share calculation. The denominator is weighted average common shares outstanding. So we got to figure out how to calculate that. And we're going to use a table to do so. You need to be familiar with how to create this table. Any table that you might use or create on the test is not going to be this complex, but you certainly need to be able to use one. I'm not going to it's not going to be too complicated, but you just need to be aware of how to navigate this. And so the first thing you do is I always fill in the first two columns first. And so I kind of walk through and I say, okay, there's different dates that are relevant to this example, and there's the number of physical shares outstanding on any one of those dates. And so initially, there's 100,000 shares outstanding. So from January 1st until anything else happens, we have 100,000 shares. And then on not on I should have said on March 31st. I don't know why I said 2/1. That's annoying. Hold on a second. Let me make sure I have that right. Just to change that, it's just going to bother me, which means it's going to really bother me. Did I do that ever all the way through? Oh, I did. All right, well, whatever. All right, it's going to be wrong in the future slides. I don't want to change it all right now. So then on March 1st, we issue an additional 25,000 shares. So the number of shares physically outstanding goes from 100,000 to 125,000 shares. Then the next step is then on on June 1st, we have a 10% stock dividend. And so that 10% stock dividend increases the number of shares outstanding by 12,500 shares. So the total number of shares now goes from 125,000 to 137,500 physical shares outstanding. And then on 8/1, we have a share repurchase. So they repurchase 10,000 shares. And so instead of having 137,500 shares outstanding, now we only have 127,500 shares outstanding. And then finally on October 1st, there is a 3-for-1 stock split. So now the number of physical shares outstanding goes to 382,500 shares. So the next step in this process is to figure out this adjustment. Now, when we talk about the adjustment, what we're trying to say is a share on January 1st, if there are stock dividends and stock splits, is not really comparable to a share on December 31st. And so the idea is if I have, let's keep it simple, if I have 100 shares, or I'll just say 10 shares, if I have 10 shares on January 1st and I do nothing, but hold on to my 10 shares, will I still have 10 shares at the end of the year? And the answer is no. And the reason why is because there's a 10% stock dividend and there's a 3-for-1 stock split. So my 10 shares would become 11 shares when there's a stock dividend. And then my 11 shares would become 33 shares when there is a 3-to-1 stock split. And so having a share on January 1st is not the same as having a share on December 31st. And so what this table is trying to do is to make everything comparable. And the answer is comparable to what? Well, it needs to be comparable to the state of the firm on December 31st of the fiscal year. So at the end of the fiscal year. So I have to adjust any previous rows in order to make them comparable to the end of the year. So that's what this adjustment column is intended to do. It's intended to make shares in that row comparable to shares in the last row. And we can see that it's not necessarily the case. And so let's look at this. So the first adjustment is, let's just kind of move up a little bit, move up the row. So let's think about what it means to have a share on 8/1 versus having a share on December 31st. So on August 1st, let's say I had 10 shares and I did nothing but hold that share. Well, on October 1st, my 10 shares would turn into 30 shares. And so there's a 300% adjustment that needs to be made because we have 30 shares compared to 10. And so in other words, if I did nothing, my 10 shares become 30 shares. And so to make them comparable, I need to make a 300% adjustment to any shares in that row. Similarly, I need to make a 300% adjustment to any shares in the June 1st row. Again, if I have 10 shares on June 1st and I do nothing else but hold them, by the end of the year, those 10 shares will have turned into 30 shares. So that's a 300% adjustment. Now we get to February 1st. Now, I want you in the chat, I know there's not quite as many of you out there right now, but for those of you that are still hanging in there, on February, or I should say, I'll just kind of change this real quick. On March 1st, so on March 1st, if I have 10 shares, how many shares will I have on December 31st? If nothing else, I just hold on to my 10 shares. How many shares will I have on December 31st? See if anybody can get it. If I have my 10 shares, and then at the end of the year, how many shares will I have? 30.6. Let's see if anybody else chimes in. Harry's still hanging in there. The other one says 30.6. Okay, let me walk you through it. All right. So, on March 1st, I have 10 shares. Richard says 30. Then on 6/1, there is a 10% stock dividend, which is how we went from 125,000 to 137,500. So, what happened? I had 10 shares, and now I have 11 shares. Keep marching on. I still have 11 shares, 11 shares, 11 shares. Then October 1st, there's a 3-for-1 stock split. My 11 shares turn into 33 shares. So my 10 shares become 33 shares. So what is the adjustment that I need to make to that row? So if my 10 shares become 33 shares, what is the adjustment? See if you can put that in the chat. 10 shares turning into 33. What is the adjustment factor? So 300%. 3.3, which would be 330%. See if anybody else chimes in. One of those is right. I'm going to tell you right now. The concept behind Harry's is 330%. So it's either 300% or 330%. It's one of the two. Go ahead and chime in if you want to side with somebody. All right, the answer is 330%, and that's applicable to both of the first two rows. Again, 33 over 10 is 330%, so that's how you get the adjustment. My 10 shares turned into 33 shares. That's a 330% adjustment. All right, now the weight column. So the weight column basically says, well, each of these rows represents a portion of the year, and so the weight is the portion of that year. And so we're going to use monthly weights. You could use daily, but most companies for an annual earnings per share, they're going to use a monthly weight. And so we're just kind of, the first row is 2/12, the second row is 1/12. Hold on a second. Boy, I really jacked up these dates, didn't I? Let me go back. April 1st. Oh, you're kidding me. All right, I really did jack up these dates. Let me get to the last one. Where are we just at here? Why did I do that so bad? I must have switched the dates at some point or something like that. I don't know. It's painful. I think all these are jacked up. I feel bad about the dates, everybody. I am so sorry. That should be 3/1. July 1st, November 1st. Wow, I really did jack these up. All right. So now to explain it again. So each row is the first row is 2 months, Second row is 1 month. The third row is 3 months, and then 4 months, and then 2 months for a total of 12 months. And so again, the whole idea here is we're weighting based on the number of months where we had that physical number of shares outstanding. Again, some companies could use a daily average. We're going to use a monthly average, and we're always going to make sure that something happens either at the beginning of a month or something like that to keep it clean. Now, as far as the rest of these dates, I just need to do something real quick, just to cause me to not have more heartache than I already have. Let's go back up here. All right. So then what do? So we're trying to get to this idea of weighted shares. And so in order to get weighted shares, you have your physical number of shares, you have the adjustment factor, and then you have the proportion of the year where you had that physical number of shares. And so to calculate weighted shares, we multiply across. So you take the physical number of shares, you multiply it by the adjustment factor, and you multiply it by the weight, and from that you get your weighted shares. And then the weighted average common shares outstanding is the sum of that final column. So the whole point of this chart is to get to weighted average common shares outstanding. And so each row gives you weighted shares. You add up all the rows, and that leaves you with your weighted average common shares outstanding. Again, this is kind of a tedious process, so I would definitely suggest going back through this and making sure you can follow the calculations, and hopefully that will get you there. Again, the weighted average common shares outstanding. That's the whole point of this calculation. All right, so then to the actual earnings per share. So our basic earnings per share then is the numerator over the denominator. Now the one thing to highlight here is when we report our basic earnings per share, we report it to the nearest penny. And so we would report $1.21 per share. Yeah, it is. Yeah, these you're going to see in accounting, like there's certain approaches that we do over and over again, like amortization tables, and this is another one. Like weighted averages are another common thing that you see in accounting. All right, so basic earnings per share for this problem would be $1.21 per share. Now to diluted earnings per share. So again, these are outstanding contracts where the contract holders can induce the firm to issue more shares. Some examples are the employee stock options, convertible preferred stock, or convertible bonds. There could be others, but these are kind of the main ones we're going to talk about. So these will all increase the number of shares outstanding, and it could impact our earnings per share. So firms with complex capital structure, hold on a second, there's something, what is it saying? I guess there's some error. I'm not sure what's going on. Hold on a second. All right, I think it was just, hopefully it's all right. In the chat, if there's a problem, if you're still hanging on there, let me know if there's some problem. I just got an error message from YouTube, so I'm just making sure that I didn't miss something. So again, in the chat, if there's a problem, just let me know. So firms with a complex capital structure have to report diluted earnings per share along with basic earnings per share. So that is a requirement under US GAAP. It's important to note that the diluted earnings per share is kind of a worst case scenario. And so in other words, we want to think how low could earnings per share be if all of these contracts and securities were exercised. And so you have to get to this notion of dilutive versus anti-dilutive. So dilutive means that the action decreases earnings per share, whereas anti-dilutive means that the action increases earnings per share. For diluted earnings per share, we only include dilutive securities. We ignore anti-dilutive securities. So just be aware of that. Looks like the error went away. All right. All right, so let's talk about employee stock options. Basically, with an employee stock option, we already talked about that. The firm would issue shares in exchange for cash. The question is, when the firm receives the cash, what are they going to do with it? And in this, under U.S. GAAP, we assume that the firm is going to repurchase shares in the open market with any cash that is received. Now, what I want to be clear here, that doesn't mean under U.S. GAAP that they have to do this. What it means is when we report diluted earnings per share under U.S. GAAP, we want it to mean the same thing for every single company. And so what they're saying is, regardless of what you plan to do with the cash, we want you to report diluted earnings per share as if you would take that cash and go buy shares in the open market. And that way, when I see diluted earnings per share for company A and I see diluted earnings per share for company B, if they both have stock options, I can compare the two. Because I don't have one making one assumption and then the other one making a different assumption. They're making the same assumption. And so it's just a mechanism to allow diluted earnings per share to be comparable across companies. And so it's really important that you understand that this is an assumption under US GAAP and that these options haven't actually been exercised. They're just outstanding and they could be exercised. And so there is a net effect on the denominator of earnings per share. Remember, I have to give them shares, and then I'm going to go out and repurchase shares. And so shares being issued and then shares being repurchased means that there is a net effect on the common shares outstanding. So with conversions, there is a numerator and a denominator effect. So again, you have to issue the shares, but now I don't have to pay preferred stock dividends, and I don't have to make any interest payments. And so there's both a numerator and a denominator effect when you talk about convertible preferred shares and convertible bonds. So again, with each conversion, there could be an increase to the numerator and an increase to the denominator. And so again, with each of these, it's unclear whether or not there necessarily would be a dilutive effect. So you have to analyze each one and figure out, okay, is this particular security dilutive or is this security anti-dilutive? And we include the dilutive ones and we ignore the anti-dilutive ones. All right, so this is a very lengthy example, and this is in your book. Or sorry, not in your book. This is in your notes, and so don't worry about copying all of this down. And again, this is a situation where I've given you everything that I can possibly give you. It's all thrown into one massive problem. The test will not have a massive problem like this. We're going to have bits and pieces where you have to kind of know how to do each bit and piece, but I'm not going to have you do this exhaustive diluted earnings per share calculation on your exam. Now, in the old version of the test where it was in class, I used to have students do that. So one benefit of having the online class is that this diluted earnings per share, it would be like 15% of your test. And I can't sit down and say, give me one number, and it's all or nothing. I'm not going to do that. And so instead, I broke this up into pieces, into something more reasonable. And so there's a bunch of information here, and just to save time, I'm not going to read through all of this. Just understand all this information is in your notes. If you want to read it in detail later, you can. Instead, I'm going to take this information, and I'm going to start marching us through the diluted earnings per share calculation. The first thing we have to do is calculate the firm's basic earnings per share. And so in the numerator, the net income is $500,000, and that's just given up in that first paragraph. It says on December 31st, the firm reported $500,000 in net income. There are two series of preferred stock. There's a 7% preferred stock and there's 9% preferred stock. Again, that's given in the second and third bullets. Again, I'm not going to spend time reading it, but that information is all given in the second and third bullets. And so the total preferred stock dividend for the first series is $35,000, and for the second series is $9,000. And then with the denominator, we know that the weighted average common shares outstanding are 400,000. And the reason we know that is because initially there are 200,000, and the only thing that happens during the year is a 2-for-1 stock split. And so then at the end of the year, there are 400,000 shares outstanding. With the adjustment to our 200,000 initial shares outstanding, it's just simply going to be 400,000 shares. And if you're not sure how I got that, feel free to create a table and calculate it on your own. But I think for most students, that's going to be a fairly straightforward calculation. And so our basic earnings per share, given this information, is $1.14 per share. And so what we're thinking about from here on out is saying, okay, what types of securities might we have that would decrease our earnings per share? And our starting point is $1.14. All right, so the first thing you do when you get to a diluted earnings per share calculation, and I will say my approach is not 100% the same as the book approach. I have mine more in a lockstep, like do steps 1, 2, 3, 4, and then it kind of gets you to the right answer. I think the book approach is a little more kind of hodgepodge. You can use either one, but students largely have been more successful when using the exact approach that I lay out here. The first thing that you do is you look to say, okay, do I have any stock options that are in the money? All right. So if there are in the money stock options, essentially that's going to be a situation where through this transaction there would be more shares issued than would be repurchased. And so this can be determined by comparing the exercise or strike price to the average market price. And so if the exercise or strike price is less than the average market price, in that case, it's in the money. If the exercise or strike price is more than the average market price, then that option is out of the money. You ignore out of the money stock options. All right, so we only include in the money stock options. All right, so there are two series of stock options. We know the average market price is $15 per share. Now, our exercise prices for the options have not been split adjusted. Given there was a 2-for-1 split, we need to split adjust the exercise prices. And so for the first series, the split adjusted exercise price is $12.50. That's less than the market price. Therefore, the first series is in the money. The second series has a split adjusted price of $17.50. That is above the market price. So the second series is out of the money. We would ignore the Series 2 options. We only focus on or only include the Series 1 options. So how do we do that? The first thing we have to figure out is, well, how many shares are going to be issued as part of this series? Well, the original number is 100,000 shares, 100,000 options. But again, with split adjusting, we need to double that. And so we would have to issue 200,000 shares if the employees were to exercise these options. We would have to issue 200,000 shares. How much cash would we receive? Again, the split adjusted exercise price is $12.50, which means we are going to receive $2.5 million whenever the employees exercise these stock options. And again, by assumption, we would take that cash and we would repurchase shares in the open market. So when we repurchase, we take the $2,500,000 and we divide it by the average market price of $15 per share, which means that we could repurchase 166,666 whole shares. Now I understand that it actually is 0.6666667, but you can't buy 2/3 of a share, and so you have to truncate. And so we would repurchase 166,666 shares. Where'd you get the 1250 from? So if we go back to the original problem, it says that the exercise price, there are two series. One has an exercise price of $25, which is the first bullet. The other series has an exercise price of $35 per share. Neither of these are split adjusted. So given that these prices are not split adjusted, and given that there is a 2-for-1 stock split, we have to divide each price by the split, which is 2, in order to get the split adjusted exercise price. So that's where the $12.50 came from, and that's where the $17.50 came from. It's the split adjusted exercise price on these options. Hopefully that makes sense. So what that means at the end of the day is we would issue 200,000 shares. We'd use the cash that we received to repurchase 166,666 shares, which means in total we would issue 33,334 new shares if these options were exercised. So this is the net shares issued. This is the number of shares that we need to pay attention to. So now our new earnings per share. If the in-the-money stock options are exercised, The numerator is the same, but now we would have an additional 33,334 shares outstanding. So now our new diluted earnings per share would be 1.0523. So now with any subsequent securities, we'd have to ask ourselves, okay, in exercising those securities, would diluted earnings per share be lower than 105.23? If the answer is yes, then it's dilutive. If the answer is no, then it's anti-dilutive. So again, this is our new baseline now. So our previous baseline was $1.14. The new baseline is 105. And we kind of keep working down from there. So the next step is to examine each of the conversions. And so when you talk about preferred stock conversion and bond conversions, you lump them together. There's a lot going on this page, so I'm going to walk you through it very carefully. So each conversion has a numerator and a denominator effect. In the case of a preferred stock conversion, the change in the numerator is that I no longer have to pay the preferred stock dividend. The change in the denominator is that whenever they're converted, I have to issue common shares outstanding. And so with this first preferred stock conversion, the dividend was $35,000. And so that's why if I don't have to pay that dividend, the numerator would increase $35,000. In the denominator, if we go all the way back to the contract, this is the second bullet. It says that each share can be converted to 7 shares of common stock, but that this conversion has not been split adjusted. And so we have 5,000 preferred shares. Each share can be converted to 7 common shares. And so let's go all the way back. So that's where we get the denominator. So there are 5,000 of these preferred shares. Each share can be converted into 7 common shares according to the contract. Since there's been a split, that contract would have to be split adjusted, meaning that instead of 7 common shares, each share would be converted into 14 common shares. And so the total number of shares that would be issued would be 70,000 shares. And so the preferred stock conversion effects would be 50 cents per share. Now that 50 cent per share effect is less than $1.05, which means that it's potentially dilutive. Now, I want to talk a little bit about why I know this would be potentially dilutive. Because there is a numerator and a denominator effect. If you could imagine, like, let's say that I have 0 and 10, just the numbers 0 and 10. If I said, what's the average between 0 and 10? You would say 5, right? 5 is the average between 0 and 10. Very, very obvious, okay? Similar if I said, what's the average between 50 cents and $1.05? Well, you'd say somewhere, whatever halfway in between is. The only thing here is that there's really a weight to this. In other words, the size of the numerator and the size of the denominator is very different between this preferred stock conversion and our basic EPS. Notice the newly diluted earnings per share. Notice the size is vastly different. It'd be like saying, what if I had 1,000 tens and I had 1 0? What's the average of all of that? Well, you'd say, well, it's really close to 10, but a little bit less than 10. And that's the same thing here. Like if I combine this preferred stock, or if I convert this preferred stock, the new earnings per share is going to be somewhere in between $1.05 and 50 cents. It's probably going to be a lot closer to $1.05 than it would be to 50 cents because just the weight of the two is different. And we don't have to necessarily calculate that now, but you need to kind of understand that if I combine these two items, the combination is going to be somewhere between $1.05 and 50 cents. It's going to be somewhere in between those two. And so we need to understand that. We need to understand that when I combine these two items, the result is going to be somewhere between the two. All right? That's just the reality of it. That's why this is potentially dilutive. There's a similar situation with the other preferred stock conversion. In this case, the preferred stock dividend is $9,000, and instead of being convertible into 7 shares of common stock, each share is convertible to 5 shares of common stock. Again, it needs to be split adjusted. And so what we see here is that the effect is 90 cents per share. So when I combine 90 cents per share to $1.05 per share, we know that their combination is going to be somewhere in between those two. Probably closer to $1.05 than 90 cents, but somewhere in between those two. And that, again, you just need to absolutely understand that when I combine the preferred stock conversion effect and my diluted earnings per share, the result is going to be somewhere in between the two. Again, much like an average of two things is going to be somewhere in between the two, and depending on how many there are, it could be closer to one or the other. Again, there's this weight to this that we need to be thinking about as we walk through each of these conversions. So now with the bond conversion, again, a lot going on, so I need to kind of walk you through each, and we're going to go all the way back and look at the terms of the bond. So this is the fourth bullet. The firm has 3,000 convertible bonds. Each has a face value of $1,000 that were issued at par with a coupon rate of 6%. And each bond is convertible to 40 shares of common stock, and this is not split adjusted. So 3,000 bonds, 6%, 40, all that kind of stuff. And you kind of similar information for the next one that we'll be using. So then we go back to our convertible bond. And a couple of things that we notice. First of all, in the second group of parentheses, you see that 6% times $1,000 per bond times 3,000 bonds. Again, this is the back to that information. Just going to kind of go back one more time. Again, 3,000 convertible bonds. Each bond has a face value of $1,000, and the coupon rate for each bond is 6%. So that gives you the interest expense for that bond, or for that series of bonds. And so the interest expense would be 6% times 1,000 times 3,000. That would be the total interest expense. It's very important to note, though, that interest expense is a pre-tax item, whereas net income, which is what we use for earnings per share, is an after-tax item. And so what we really need in the numerator is the after-tax effect. Now with preferred stock, that's after net income. So it already is after tax. So there's no adjustment for the preferred stock conversion. But with the interest expense, it is pre-tax. And so we need to make an after-tax adjustment. So the way you do an after-tax adjustment is in that first term in the numerator, the 1 minus 0.3. The tax rate is 30%. And so the after-tax effect of the interest expense is 60%, is 0.6. And so that's what we get from the after-tax. So 0.6 times the interest expense gives us $126,000. And then the conversion option on these bonds says that each bond can be converted to 40 shares of common stock. Again, that's not split adjusted, so we multiply by 2 in order to split adjust it, which gives us 240,000 shares. So the change in the numerator is 126,000 if we do not have to pay the interest expense on these bonds. And the change in the denominator is that we would have to issue 240,000 shares at the conversion. So the effect is 52.5 cents. And so again, much like the previous two, this is potentially dilutive because the combination of the two would end up somewhere in between $1.05 and 52.5 cents. We have a similar calculation for the second bond conversion. Again, we have the after-tax effect in the numerator and then the conversion effect in the denominator, of course, making the split adjustment. In this case, you can see that the after-tax interest expense is $350,000. And the denominator is an increase to common shares outstanding of 280,000. In this case, the effect is $1.25. Now that $1.25 is greater than $1.05, which means that this conversion is actually anti-dilutive. And since it's anti-dilutive, it means that we would ignore this conversion. So this conversion would not be included in our diluted earnings per share calculation. We already know that it's anti-dilutive, so we would ignore it. Again, there's a lot going on with these calculations, and the nice thing is you have access to these slides, so if I'm moving through the calculations a little too fast, you have access to these calculations after the fact. Okay, now the next step, all right? You want to start with the conversion that has the most potential dilutive, or the most dilutive potential. And the reason that we want to do that is we talked about that $1.05 being kind of the top end. And then the bottom end is whatever the effect is. In this case, with the preferred stock conversion, it's 50 cents. And so their combination could be anywhere between $1.05 and 50 cents. Okay? Now let's say that it's all the way down to that 50-cent number, as close as it can be. Like, for whatever reason, when I combine those two, it just really drastically dilutes the earnings per share. What that means then is anything above that is now anti-dilutive, because now let's say that the new earnings per share, instead of being 97.5 cents, was something like 50 cents. Everything above that now is anti-dilutive. We're going to illustrate that here in a second. But you start with the most dilutive potential, which in this case, so that lowest number, the lowest number was 50 cents. So that has the most dilutive potential. And so we include that one first. And so that the numerator is an increase of 35,000. The denominator is an increase of 70,000. And so now the new diluted earnings per share is 0.9755 per share. And so now we have to ask ourselves, are the remaining items still dilutive? The bond conversion is, because if you remember, the bond conversion had an effect of 52.5 cents per share. Well, 52.5 is less than 0.9755. And so their combination is going to be somewhere in between 97.5 cents and 52.5 cents. Somewhere in between the two. We don't know exactly where, but somewhere in between the two. And so we need to include that bond conversion because it is the next most dilutive. And so the 126,000 in the numerator and the 240,000 in the denominator, when I combine them, I get a new diluted earnings per share of 83 cents. And so let's talk about that 83 cents and compare it to our second preferred stock conversion. So notice here that the second preferred stock conversion has an effect of 90 cents per share. So again, we're at 83 cents per share. And now this effect is at 90 cents per share, which means their combination is going to be somewhere in between. Well, let's think about that. Somewhere in between means greater than 83 cents. And our diluted earnings per share is supposed to be the lowest diluted earnings per share possible. Do not include anything that would be anti-dilutive. And at this point, this preferred stock conversion would be anti-dilutive. And so when we go back, hold on a second. Alright, sorry about that. My dog was going to start to go nuts, and so they're going to put her in a room somewhere so she doesn't. So again, this is the most remaining dilutive potential. So our new diluted earnings per share is 83 cents. Now we're comparing that to the second preferred stock conversion. Again, the EPS effect from that second preferred stock conversion is 90 cents. That 90 cents is now anti-dilutive. So that means we had already reached our worst case scenario, and our reported diluted earnings per share would be 83 cents per share. And that is the end. Whew. Just short of 2.5 hours. I know that's long. Way to hang in there, everybody, but I'll hang out here for a second in case you have any questions. If you want me to go back through any of these calculations. Again, I tried to go I didn't want to go too fast, but I know it's a long lecture, so I didn't want to go too slow either. I just want to make sure there are no questions. Okay. All right, well, this will be up and running here probably... sorry, Nate. He's still 30 slides behind. Sorry about that. That was me slowing down too. I know some of the, again, what you might want to do is, I think I had mentioned this to a few people. What I would do is in the lecture guide and with the slides, on your own before I lecture, you can kind of try to fill in some of the information to sort of speed up your note taking, and it's going to actually help you prepare for the lecture as well. If you didn't get a chance to do that, you can always kind of after the fact catch up. But obviously, Nate, if you're still 30 slides behind, that's okay. I understand that. You can always email me questions after the fact. But again, diluted EPS, definitely pretty heavy. Good, Samantha. I'm glad they're helpful. Sort of a last call on questions. All right, everybody. Thank you so much. Have a great day. For those of you that are making appointments, I'll see you on Friday. For everybody else, please prepare well. And I hope to see everyone do really well on the second test. All right. Take care.